The financing panel, a key to geothermal heat pump affordability, was moderated by John Ciovacco of Aztech Geothermal with panelists Robert Fischman of Energize, New York, Wendy MacPherson of NYSERDA, Hal Smith of Halco Energy, and Tim Weaver of Diverso Energy. It was presented at the NY-GEO 2018 conference on April 18th, 2018, and you'll just see a single slide. There are no visual presentations for each presenter. You'll just hear the audio. On to the panel.
All right, we're going to call this thing to order. So welcome to the financing panel. I will be your moderator. Love that. Because I love the financing panel. I do think that it's one of the things that always puzzled me in this industry is that we oftentimes sell something that is considered to be expensive, more expensive than some alternatives. And at the same time, let's say a car, for instance. Almost all cars are financed in some way. Almost all. Now, you might be a person, I always pay cash, I do this and that, but you're not most people then. Because most people are trying to figure out a way to live on a cash flow basis and to try to make something affordable to them. The nice thing that we have that cars don't have is that we don't have this rapidly depreciating, in reality anyways, rapidly depreciating asset. We have something that actually would save you money. Can even save you so much money that that payment that you make, even if it's a long payment, you end up paying a lot of interest. That payment plus the energy that you use could be less than you're paying now for energy. That kind of math has always intrigued me, and I've really worked hard to try to bring that to my customers and to encourage other people to access financing so that we can make a technology like ours more accessible to more people. And the investment argument, which I think is right, I think to say it's a great investment and you show them their cash flow and everything, but if someone can't afford it, it doesn't matter if it's a great investment. It just doesn't matter. You know, if somebody tells me a Tesla is a great investment, I can't figure out a way to finance it to make it affordable. Most people can't buy it. So I want to quickly introduce the panel and then go through a little bit. We've got Wendy MacPherson from NYSERDA, and she'll talk a little bit about some of the work. She works on both the residential and commercial side, so she can talk to both those things. We've got Hal Smith from Halco Energy, and Hal is a contractor that I've always had a lot of respect for, does all kinds of great stuff, and certainly is someone that has found ways to offer financing to his customers probably more than any other contractor in the state, and so I thought he would be a good person to hear from. That's true. I just think that's just blatantly true.
I'm not sure where you get your facts from, but I'll buy it.
Who cares? You know, I have the microphone. I'm good. We've got Tim Weaver from Diverso Energy, and Diverso is he's Canadian, so he's got a little bit of a funny accent, and but otherwise is okay. Yep. Hockey playoff time, so it's good to have him here. But he does some really terrific stuff, mostly in Canada now, but we're trying to move it to the U.S. on commercial financing of loop fields, and usually for larger buildings. So we're going to move into some of that stuff. And then we have Robert Fischman, we'll call him Bob, because we know him pretty well. And he does a lot of work through Energize, New York, with PACE financing, and really just trying to find creative solutions. And he'll talk about what PACE is, which is an acronym that I can never remember. But also, I'm glad a number of you do, though. But Bob will talk to us a little bit about that, mostly commercial and larger system-oriented there again, too. But the concepts are all the same. People need to find ways that they can afford these things, all types of energy systems. And so you can even broad brush it. So why don't we start out with Wendy to talk a little bit about what NYSERDA is doing. And some of it was talked about a little bit in that first session, but she'll dive in a little more. It's all you.
Hello. Thank you. Thanks, John. And panel. Good afternoon. And as your lunch settles, let me talk to you about some financing. I'm happy to announce that NYSERDA is expanding the Green Jobs, Green New York financing to residential customers through the ground source heat pump contractors. Okay, thanks. Now I can hear this.
Yep.
Thank you.
You can hear you. We're good.
So just in case you missed it, NYSERDA will begin to, it's now offering Green Jobs, Green New York financing to residential customers through the ground source heat pump contractors. Soon these contractors are going to be receiving an email invitation to an informational webinar and also to sign up to participate in the program. So Green Jobs, Green New York is a statewide program. It was introduced back in 2009. And the full program provides New Yorkers with access to energy assessments, to installation services, to job training for green economy jobs, and also low-interest financing. And it's the low-interest financing portion of the Green Jobs, Green New York full program that I'm going to talk a little bit about today. The loans are offered to customers through participating contractors. So in order to have access to these loans, you have to be a qualified contractor in one of NYSERDA's eligible incentive programs. And also, you must be qualified and trained by NYSERDA's loan underwriter. The other programs that currently have access to these loans are the home performance programs, the New York Sun, Renewable Heat New York, and now ground source heat pump rebate contractors will have access to these funds, to these loans to offer them to their customers. All of these loans are unsecured. The loan amounts at a minimum are $1,500, at a maximum are $25,000. The loan term can be chosen between 5 years or 10 years or 15 years. And the interest rates are subject to change based on a customer's credit qualification. The loan approval criteria includes the customer's credit score, their debt to income ratio, other standard and historic history finance stuff. And the range currently is between 3.5% up to about 7%, depending on the applicant's income level. There are two types of loans that are offered. The only difference between these two loans is the method of repayment. So the first loan is a smart energy loan, and that is kind of a standard loan, just like an auto loan or a student loan. And that's repaid in installments to NYSERDA's loan servicer. The homeowner can have multiple smart energy loans, but the maximum of the total loans is $25,000. And if that home is sold, the loan has to be paid off before the home is sold. The other type of loan is an on-bill recovery loan, and that loan payment is built into the resident's utility bill. So in order to participate in that, first the customer has to be serviced by one of the investor-owned utilities in New York State. And that includes National Grid Upstate. Also, PSEG offers the Green Jobs, Green New York financing through their ground source heat pump program as well. A little bit of difference between the on-bill recovery and the smart energy loan. The monthly payments cannot exceed the monthly energy cost savings. So there's a little bit of an extra cost-effectiveness test there to access that type of payment. And the loan actually stays with the meter, so if the home is sold, that loan is transferable to the new homeowner. To offer the Green Jobs, Green New York loans, the contractors, the eligible contractors that are participating in the grant apply to and become approved by EFS, Energy Finance Solutions, who is NYSERDA's loan underwriter. It's a simple application process. You fill out a participation agreement, submit a W-9, insurance certificate, a couple of documents. It's a pretty quick turnaround once those documents are submitted. It's 1 to 2 days, and then you're able to offer the loans to your customers. There's also provided and this tool helps to estimate what the customer's loan amount would be and also what the monthly payments could be. And you can do some what-if scenarios in there with regard to the cost, with regard to the savings, the length of the loan, monthly payments, that sort of thing. So it's a helpful tool. And I think it would be quite helpful in discussing the project with your customers and talking about the cost of it as well. the customer actually applies to EFS for the loan. The interest rate, the actual interest rate and payments that they'll actually pay is approved by EFS. It's determined and approved by EFS back to the customer. What EFS provides to the contractor is a portal so that you can be notified and track your customer loan activity. So you can look in there to see who applied, because when the customer applies, they check a box for a contractor. If you're an available contractor, they can check your name. So you see who applied, you see what status their application is in, when they're approved, so you kind of follow that through. And then once the project is installed, once the installation is complete, NYSERDA notifies EFS, and EFS remits the payment to you, the contractor. And again, that they've got a quick turnaround time on that. So the next steps from NYSERDA's perspective, in order to kick this off and to get it moving for the ground source heat pump contractors, is that there is an announcement email that will go out in the next week or so to request that you attend an EFS-hosted onboarding webinar. And during that webinar, they'll describe the loan process as well as how to become a participating contractor. So keep your eyes out for that. And if you're not currently a ground source heat pump rebate qualified contractor, and this sounds really interesting to you, please sign up to be a ground source heat pump rebate contractor. You can see myself or one of my colleagues here at our table at the exhibition hall, or certainly go onto our website and take a look at it and see what it is, what it's all about. Thanks.
Great. Thanks so much, Rolf. We'll have time for questions for the whole group after, so hang on to those. All right, Hal? And Hal has used the green industrial in New York financing quite a lot.
And I have the microphone ring.
Well, maybe we both do, but go ahead.
Oh.
I'll stay away.
So, I wanted to start by talking about the NYSERDA financing. And we've used it for a lot of years as home performance contractors, so we've been able to use it for geothermal jobs in the past because we've had access as a home performance contractor. In my opinion, I think some things have been misconstrued. NYSERDA started out with this great loan at 3.49%, and it was that rate for everybody. And then they come out and said they can't sustain that. You know, their funds are dwindling and can't sustain the 3.49%. And private lenders were saying we can't compete with 3.49%. It's unfair. So NYSERDA said, okay, we gotta back off, and they made they increased the rates for some customers, for higher income customers. I think, in my opinion, too much has been made about the interest rate, and not really what the loan is about. The loan is really about the fact that it's an unsecured loan, okay? And that it's an unsecured loan for 15 years. Private lenders aren't giving you an unsecured loan for 15 years, okay? If they are, they're asking for a substantial dealer fee. If you're trying to get a 7% loan for a customer, unsecured for 15 years, you're going to pay a dealer fee 10 to 15%. It's 10 to 15% of the loan up front that gets taken right off the top of what the dealer gets funded. That's a big deal. That's huge. So, in my opinion, I would much rather NYSERDA come and say, hey, we're charging everybody 8%, whatever's sustainable, that they could keep the program going and have an unsecured loan and have that long 15-year loan, because you need the 15 and even 20-year loan to keep those payments where your savings are going to match up to your payment, right? Because there's going to be savings with the geothermal you put in, but you can't do a 3-year loan or a 5-year loan and have those savings match up to the payment. So you need that 15-year loan. I feel not competing with the private market. I think at 3.49 it was misconstrued that they were, and so make it 8%, 9%, but keep an unsecured loan without a dealer fee for the length of time, and make the if that 8 or 9% is sustainable for NYSERDA, make it so that you can have more than 25,000. Because I can tell you that we've done a lot of customers that are doing both solar and geo, and that's what we want, right? We want net zero homes. Well, you can't do a solar or a geo for $25,000, not even remotely close. So if NYSERDA could up the amount that was available, got a big wish list on it. I mean, if they would up the amount that was available, even at a higher interest rate, it would be a bargain. Because on the private market, I'm telling you, you're going out and paying a stiff dealer fee to get that, just to show the customer, oh, we're giving you this 7% loan. Well, you're not giving them a 7% loan. You're giving them a 7% loan after you paid a 10 or 15% dealer fee. That's the fact. So anyway, other types of financing that we've used with our company and been successful. We've done a lot of jobs where we always use the NYSERDA loan, the maximum $25,000, and then we'll pair it up with something else, which is burdensome. It's complicated. The customer now is making 2 loan payments. It's not fun, but that's what we've done.
How many customers do you have that maybe use the NYSERDA loan with another, not a private product, as a percentage or something? Lots? Hundreds?
Lots. Yeah. So I mean, the 25,000 when you start talking renewable energy is not enough. I mean, it doesn't cut it. But people are all hung up on this. We get hung up on a lot of work, a lot of empowered assisted home performance work, and serving those communities say, well, that low rate needs to be held for that customer. I disagree. You're already giving that customer a half-price furnace with an assisted home performance job. You're already giving them no-cost services for Empower. That customer, even if they pay the 7 or 8%, is still way ahead of the game. I'd rather see you accept more customers because the approval rate has gotten less and less as times went on. The credit criteria. I guess the point I'm trying to make is not about the 3.49%. It's about the unsecured loan and the length of the time. And a lot more focus ought to be put on that than trying to keep this low rate that's unsustainable. My opinion.
Just a quick note is that Hal's company and my company as well, we do participate in home performance, and we have used Green Jobs Green Year prior to this. But the big, that product is now being accessible through the ground source heat pump rebate program, and that is a big deal, and will give access to many more contractors. And we would both agree that sort of like lots of things, board small, it's a special product, and if you're not familiar with it, you probably want to follow up with Wendy or Donovan, some of the other folks, NYSERDA, or talk to Hal, because we're fans. As much as we always want, what's the next thing we want? But we're fans for sure.
Well, there was a 0.49% went away. I'm saying, don't fight this. We'll take it at 8% all day long. Just make it a higher level.
Because we can make it affordable with that.
For sure.
Yeah.
All day long.
Right.
We've had customers that we've had them cash in the retirement account to make a job. They're doing a combination solar, geothermal, retirement accounts these days aren't paying a lot of money, a couple percent. So by cashing in the retirement account, they do 2 things. First of all, they instantly create a tax liability, so now they can use these federal tax credits immediately, and they're getting a much better rate of return by putting a solar and geothermal system in than they were with a retirement account. So that's another way we've made the math work and get people to do work. That and a company we use a lot of, Enerbank is a company that has, they've got some nice programs. They've got what they call a combo loan, where they'll do a 12-month or an 18-month same as cash for the tax credit piece. And so that's separate than the base loan that's going to be a longer-term loan. So that's a nice feature that they have, what they call a combo loan. So they separate the tax credit piece that they're loaning from the bigger piece base loan that would be a longer term.
That's great. Okay, we're going to shift gears. Thanks, Hal. We'll clap for Hal. We clap for Wendy.
Yeah.
Come on. Let me share it. And we're going to talk more about some bigger systems, and that's one of the things I know I've had lots of conversations with Donovan and others, is that, you know, we need a lot of the sort of the base of our NY-GEO contractor base and a lot of our thinking is residential, single-family residential, but there's so much opportunity with multifamily and with larger buildings, commercial buildings, that have to be addressed with clean heating and cooling. So Tim's going to talk a little bit about some of the ideas he has about that.
Good. Thank you, John. Oh, can you hear me? Yeah.
Keep it close.
Oh, all right. So I just realized.
Wendy has some great notes.
I look more like a complaint. He's got to get back after that Canada.
I'm going to have Wendy sit between you guys.
So, as John mentioned, my name is Tim Weaver, Diverso Energy, and yes, I am from Ontario, Canada, near Toronto, or an hour west of Toronto, and I've been in the geothermal market about 13, 14 years now. Closer. Okay. So I've been in the geothermal market about 13, 14 years now, and spent much of that time in the commercial space. And
John, jump in on this one. You can on that one.
the whole won't be changed.
Okay. Yeah. Hal will hold one for you too.
You're interrupting my phone.
You don't have notes anyway.
Where was I? So, commercial space, much of that time in the commercial space, and one of the problems, looking back and reflecting now, is I tried to sell commercial geothermal, the offerings the same as I did for residential many years, which was, you know, it's an upfront investment, it's got payback, there's a return on your investment, it's, you know, paid for in 7 years, and then we try to get a little more sophisticated, make spreadsheets that show an IRR, or here's your net cash flow over 30 years, here's the net present value of that cash flow, and no matter how sophisticated we got and how much, trying to show the pro forma value add, all those things, was incredibly unsuccessful. And after many years of being unsuccessful and frustrated, and kind of taking some of that out on developers, you know, you've got, especially here, and spent a lot of time here in the U.S. in the Northeast, and projects were off the gas grid, and they were propane, and there's the 10% tax credit, and all these things that we were offering, 2, 3, 1.5 year payback, sometimes 30, 40% return on investments, zero success. And when you can't sell something on a 2 or 3 year payback, it kind of forces you to pause and reflect on what's going on here. And what ended up happening is I recognized commercial is very different. And when I say commercial, I'm talking about large commercial, 1, 2, 300,000 square foot buildings, condominiums, office buildings, not smaller owner-operator type of commercial. And one of the issues, when we took some time and realized, or took the time to understand how commercial projects are funded and what the structure of that funding is, I realized something significant, and that's payback doesn't matter on a commercial project. It can be a 1 year payback, it can be a 0 year payback. What matters on a commercial project is that upfront cost. And I got frustrated with the developers thinking, this is very ignorant. You're turning down something that's going to make you all this money, save the planet. It's not them, it's the banks. Projects have a finite amount of cash available. So in other words, if a project is $50 million, even if we found financing, and this is a finance panel, and John introduced me as someone who offers financing, that's a bit of a misnomer. We don't finance. Financing is not the solution, because if a project is $50 million,
yeah, you're this close to getting pulled off this panel, buddy. You better turn this thing around.
It'll come around. So there's a limited amount of money available. The problem with financing on a commercial project is there's already 4, 5, 6 lenders involved in a project. And if you come along with $1.5 million loan for geothermal, all you're really doing is bumping out $1.5 million somewhere else, because it's financing. And the amount that's financed is based on the project, not the technology. So lenders don't really recognize geothermal as increasing the value of that project. Therefore, that ratio, those metrics they're using to determine how much money is available, there's no room. It's a thick black line. So co-founded this company, Diverso, brought in 2 partners, and we decided to completely change not only the economics of how we sell commercial, but also the narrative is much different. Commercial, I think, in the residential space is it's a long-term benefit. What we're trying to do is turn it into a benefit during construction. So not only are we taking away that cost, we try to sell it as a value add during construction. So in other words, we take away all of those, call them hurdles. And part of the hurdle on commercial, it's not just the cost, it's risk. Large commercial developers are extremely risk adverse. So to introduce a technology that the architect's maybe not all that comfortable with, the engineer's not all that comfortable with, the general contractor's not all that comfortable with, you can't just take away the cost. That's kind of like having half of a $100 bill. You need the whole thing. So with Diverso, what we've done is we've gone in and saying, okay, we're going to take away that cost. It's off balance sheet. It's not debt. It's not registered on the property. Your bank doesn't recognize this as debt. We own it like a utility. It's our asset. We're just going to put it on your property. And because of that, you no longer need a cooling tower. You no longer need a boiler. So what ends up happening? Instead of geothermal being a cost premium, we're coming in and saying, hey, you're over budget, put in geothermal. We can shave $300,000, $400,000, $500,000, $600,000 off of your budget. So kind of, again, flips the economics on its head a little bit. And from a liability standpoint or from a risk standpoint, we do the design, we do the management, we implement it, we own it long term. So there's that 30-year performance guarantee, because that's the other issue some have with geothermal, is they've heard the stories, well, you know, year 3 or 4, it doesn't work anymore, year 6, the loop's overheating, and yes, we all know that there's solutions to that, and that shouldn't happen, but those are still concerns. And when a system goes in with a 1-year warranty, that's a concern for a developer, whereas in our case, it's a 30-year warranty, because part of our contract guarantees performance. If it doesn't perform, guess what? We don't get paid. We don't recover our investment. So we're taking on that financial risk as well as the operational risk. Now, saying all that, this makes sense in certain types. I'm not saying this is a fit for every project, because it's not, or every profile of every client profile or every building profile. But where we've had tremendous success up in Ontario is with condominiums and office buildings. And what's unique about those buildings is traditionally, and one of the challenges selling geothermal into that space is you've got one entity paying for the capital and you have another entity benefiting from it. What I mean by that is the developer pays for it. They're not the one paying the utility bill. So how do they recover that investment? They sell the condos, the condo owners benefit, 3 or 4 or 5 different owners over the next 30, 40, 50 years. Well, there's a disconnect between who pays for it, who benefits. So to bridge that gap, we pay for it. The entity who pays us is the occupant, but they're also the ones benefiting from it. What the developer gets is a green building, clean roof. In Toronto, there's some certain standards now for building in the city of Toronto, so they allow them to hit those standards without spending more money on windows or insulation, reduce their construction costs, it's marketing. They can leverage it with the city of trying to get their site plan approval because it's a low carbon building. There's all these benefits they get up front. And these folks, they're not looking out beyond 18 months. Their whole world is wrapped around that 18 months of construction. So that's where we keep the conversation about how it would impact them over the next 18 months. So it's more of a utility model than it is financing. It is a financial solution, but it's not actually structured as financing.
Well, you're already done, but I don't know if you really should have been invited. No, you did great. Let's clap for him anyway. I think what Tim's doing is really neat, and I'm really looking for opportunities for him in the States that we can pull together. And one of the things that he's been in some dialogue with is like Retrofit New York, which is a multifamily LMI kind of very comprehensive program that we'll hear about tomorrow. But there could be good fits and things like that. I'm going to head off to Bob, and he'll talk a little bit about some of the financing and types of sort of project structures that he puts together for commercial buildings. Go ahead.
Thanks, John. Appreciate it. I am absolutely thrilled to be back here in the Capital Region. When I read the bios of the people on this panel, I realized that 3 of us actually are alumni of Union College right here in Schenectady. So happy to be on this, honored to be on the same panel here. First of all, you know, who knows about PACE? Who here has heard of PACE? Who actually understands it, et cetera? Okay. Yeah, okay. And put down the second one. Yeah. So PACE, and John, it is Property Assessed Clean Energy.
I'll get it.
You got it?
Eventually.
You got it. And it started in California back about 10 years ago. New York State was actually the second state to adopt PACE financing. And they did it by passing some arcane law called Article 5L of the New York State General Municipal Law. But I'm going to take a moment and read to you the preamble there, because this is actually an essential piece of what PACE is about. It says, municipalities would fulfill an important public purpose by providing financing to property owners for the installation of renewable energy systems and energy efficiency measures. So what the state said is that financing for clean energy projects is a public benefit. And PACE is a public benefit finance program. It's funded, what makes it unique is that it's actually not funded with state money. It's funded with private sector resources. PACE makes it attractive for private capital to be used to reduce emissions at a very local level. And municipalities in New York State pass PACE at a local level within the framework of the New York State PACE Finance Law, that Article 5L, because they want to see certain public benefits. They want to see emissions reduced in their community. They want to see local jobs created. They want to see clean energy jobs created in particular. And they want to see property owners reduce their energy costs and put that money back into the local economy. So these are all some of the public benefits that we see when we talk about PACE financing programs. PACE is tied to the property, not to the property owner. That's a distinct difference from what you'll find when you're looking at commercial financing. If a property owner is looking to get a loan, the bank usually goes and looks through their credit ratings and sees what their history is. PACE financing is not about that. PACE financing as a public benefit is actually tied to the property as a tax charge, right? And it's repaid through a single line item on the property tax bill that's identified as the charge for that energy improvement. And that is a concept that is age-old in this country. Actually, Ben Franklin came up with this concept when he created the first fire district in Philadelphia back in the 1700s. And he said, well, there has to be all these people take advantage of these public services. There should be a way of repaying this. And so he created the ability to put a tax charge for public benefit on the property owner's tax bill. PACE works in the same way. The difference being, instead of everybody in the community paying for it, the property owner is opting in to pay that. So without credit checks, we do have to check a few things. We want to know that the property owners are good corporate citizens. We want to know that they've paid their property taxes on time, obviously. We want to know that they paid their mortgage on time if they do have a mortgage, and we want to make sure that they haven't declared bankruptcy over the last 7 years. So those are pretty much the basic underwriting criteria. Al, you mentioned about unsecured loans and the fact that having access to long-term unsecured loans is in a way not a magic bullet, but certainly an essential piece of getting these projects done. PACE is an unsecured loan. It only becomes secured by the property when the property owner fails to pay their property tax, at which point the local municipality has the opportunity to enact a foreclosure proceeding. But it is not secured in the way a bank loan is secured. That's an essential difference. And it's available for very long terms, where Energize New York PACE is able to provide financing out to as long as 20 years. I think in the technical resource manual, John's been helping me out on this. The geothermal system is rated at 25 years.
Correct. Yep.
So our terms will go out to 20 years. We're actually looking at the possibility of extending it even further. But for now, I think 20-year 20-year financing makes the payback cash flow positive, and that's an essential piece when we're talking about PACE financing. Quick question to the audience. Simple payback on a GEO system. 5 years, 2 years, 10 years, anyone want to throw a number out? Scott? 10 plus years, okay. So if the property owner is looking at a 10-year investment and they're not sure they're going to stay on that property for 10 years, are they buying? Probably not. PACE is a transferable financing mechanism. It stays with the property. So if that property owner is concerned that a 10-year payback isn't going to work for them, they can look to PACE, because PACE will see a net positive cash flow. You take that project with a 10-year simple payback, you amortize that over a 20-year term, and you're going to see net positive cash flow in each year of that financing term. And that's one of the things that we like to see on each and every one of our projects. So that's a significant advantage. What can we tackle? We can tackle any type of building that is either commercially owned or not-for-profit owned. For the moment, we're not financing individually owned single-family residential. If it happens to be owned by an LLC, say some clever investor has student housing over at Union College and has it in the name of 123 Union Street LLC, then they certainly could finance a geothermal project there using PACE financing. But individually owned properties are not eligible for PACE as yet. And you've heard Alicia Barton this morning talking about that in response to a question that was posed by one of the gentlemen here. When will residential PACE be available here in New York State? We hope soon. Consumer protections are very important for individual homeowners. It's something we have to deal with. And we believe that the bones of the program here in New York State do address those consumer protections, but everybody wants to make sure that this is rolled out right when and if it does happen. So we do hope at some point to make that happen here in New York State. Other criteria, when the PACE law was first enacted a few years ago, 2009 in New York State, there was a 10% property value cap. This past year, the legislature lifted those restrictions, and the governor signed that into law in September. Our underwriting team has now set out new guidelines where we can finance up to 35% of the property value with an aggregate loan-to-value cap of 90%. So inclusive of the PACE loan and any mortgages, we're able to provide as much as 35% of the property's value, which for large commercial projects, is going to help a lot. So we're calling this new rollout PACE 2.0. I'm happy to talk further about that and answer any questions that people may have on the side. I think I'll wrap it for the moment and hand it back to John.
Great. Thanks, Bob. Yeah. All right. So we've got the better part of 15 minutes. So everything's pushed back 15 minutes, as some of you may have heard. So we'll end this at 2:45. So we're in good shape. Questions from the group or the panel? Or you're expert at all of this stuff already? Yeah. So, Chris, can you facilitate the microphone? Yep. Yep. I know. I'm expanding your job description. We'll negotiate after the conference. take one too.
Tim, I'm wondering if there's a
name, company.
John does growth connections controls. Tim, I'm wondering if there's a way that you look at projects that are too small for the kind of work that you're doing.
You talk close enough to it, it's a right mic.
Good question. Yes, there is a threshold. Finding projects below 70,000 square feet, it's hard to make the economics work. There's a lot of fixed costs and a variety of other reasons as well.
John, your home residence just makes it.
No comment. Could you stand up and say your name too? Yeah.
Chris Carrick, Central New York Regional Planning and Development Board. For Tim, it seems like the mechanism you're describing is similar to a power purchase agreement for solar. And if that's the case, I'm wondering how does your approach mitigate the technological risk that may be perceived if you're owning the asset, you're owning the system. If there is a problem, the customer, unlike solar, can't revert back to the utility. Right? So if the solar system fails, we have a power purchase agreement. They just buy their electricity from the utility. So how is it a comparable situation?
So to answer your first question, yes, it's essentially it is a power purchase agreement. We call it a TPA, Thermal Energy Purchase Agreement. And as far as mitigating that risk, for us, we don't necessarily see it as a risk. That's the only security we have. And you're exactly right, and that's one of the challenges with the PPA. If the customers don't have the luxury of taking the asset back, it's buried underneath the building. You know, there's $2 million or whatever it is there. It becomes very difficult for that client to install a cooling tower or boiler system afterwards. Now, that being said, we're contractually obligated that our group has to perform within certain temperature parameters. We have to provide an MV every year showing the BTU output all aligned with the original contract requirements. So there's some risk on both sides, but we know we're coming into this with a lot of experience. We know what that needs to look like to guarantee that performance for that 30-year period.
Great.
Can I add one thought?
Sure, yeah.
So, Chris, as you may know, Energize New York pays to finance prepaid PPAs on solar. Just throwing it out there that, TIPA could fall into the same mechanism. The property paying the energy for, say, 20 years, 30 years potentially, and that becomes the benefit that that it's financed through base.
Great. Okay. Tom?
A question I'm actually answering the question. You're absolutely right, and I appreciate you talking about the unsecured loan and the interest rates. And we're keeping that way to again, for income qualified folks. But here's one of the things that we actually talked about was proposing, and maybe you guys can help out in some way going forward. So we talked to a local bank, a small bank, that we talked to our green bank, where they could only go out 7 years with an unsecured loan, right? And there was this cap. So we basically said, you take the front end, you take your 7 years and unsecured, we'll take the back end, make 8 years and cover the spread. Good opportunity, good deal. The only problem was that based on they were concerned that their regulators would be concerned that they have too many unsecured loans on their balance sheet. So they were afraid it would actually succeed and they'd have this big portfolio of unsecured loans. So we can find some ways to work with lending institutions through the Green Bank. So just like this other group brought a local bank to us, if you know of banks that are interested in lending, because the Green Bank works with lending institutions, not individuals, we can probably work that out. But again, I appreciate it. You're absolutely right that this, it's an unsecured loan, 15 years, and the interest rate
Thank you.
Hi, Al Lopez, Green Home Solutions in Long Island. I totally agree with the loan that's once you cap 25,000, is there any way Green Bank or NYSERDA would encourage or welcome buying down the rate that a contractor has to pay to bring in geothermal or solar renewables, which are definitely going to cap 25,000?
They're all looking around. Grab that microphone.
Use your rebate to do that. You gotta do that, guy.
In front here.
Hi, Irene Weiser from Tompkins County, and questions for you, Bob. I think you weren't able to make it onto the phone call, but we had a conversation with Sarah in the office?
Sarah's mine.
Yeah, exactly. To find out a little bit more about how to use Energize New York in Tompkins County. And there were a couple of things that I think were in the works, and I don't have an update as to what the outcome was. So one is that right now, if there's a commercial entity that's interested in maybe doing geothermal, it's got a lot of upfront costs to get somebody in, to evaluate what's going on, to design a system, to do cost-benefit analysis. And that's before they actually invest in doing it. It's a significant chunk of money. And one of the things I think Energize New York was looking into is whether you could provide loan service to that preliminary work. And then the other, if I understand correctly, is that similarly, if they go ahead and say, yeah, let's do this, that the commercial entity has to first pay the developer for the work, and then there's some other sort of like bridge loan that happens between the initial payment to the developer and then Energize coming in on the back end. And so my understanding of the conversation with Sarah is that you're going to look into ways to help out in both of those phases, and I wonder if you have an update about that. And actually, even if I got it right, because
You got it exactly right. Thank you. Good questions. So in PACE 1.0, the way it was structured is that the project had to be completed and verified that the installation was 100% before the benefit financing could be paid out. Under PACE 2.0, these modifications do allow us to do both of those measures. We're able to now come up with a mechanism by which basically an interpretation by which the energy study is in fact the benefit and therefore can be financed with PACE up front. Okay. And then secondarily, providing financing for the project as it goes forward is something that we've been looking at as well. There are, I think, 37 states now that have PACE programs, and most of those actually do make financing available much earlier in the process. And so we are modifying things to be able to do so here in New York State as well. It may depend on the project size as we work with our capital providers to get that together. Frankly, their appetite would be for larger projects to make that happen. But the basic idea is that the PACE loan could be put out there at the time that the financing agreement is signed before the work gets underway. And just as with any other construction loan, we would be looking for certain assurances that work has progressed as each payment is then dispersed. Same way you do any other construction project. And so the idea is to make this more conventionally available. So we're heading in that direction. Thank you.
but you're not there yet, is that?
We're probably weeks away at this point, not very far away. Yeah.
Wendy's just going to add it.
If I may, NYSERDA has a program called FlexTech, Flexible Technology and Systems, and it is an energy study program, and it's a cost share, 50-50 cost share to do energy studies, and that includes geothermal and what the possibilities and cost benefits and initial costs, initial payback, that sort of analysis. So that's an available option as well.
I'm sorry, is it a loan or is it
It is not a loan. It is the cost share. NYSERDA pays 50% for the study, and you pay 50% for the study.
and only commercial or size owner?
Commercial properties.
Great.
Okay.
What about nonprofit properties?
I'm sorry?
Nonprofit properties as well?
The question was about nonprofit properties.
It's commercial properties that pay into the electric and usage.
And I think nonprofits will qualify. We've seen nonprofits use Westsec in the past. Many colleges and universities use Westsec.
Yes.
And the SBC is the systems benefit charge, which is a charge on your utility bill.
Yes, and that's.
And I knew what PACE was too. Other questions? Yep. Okay, over here. We already have one. Then
Steve Cooper, Lake Country Geothermal. My question is for Wendy, and regarding the monthly payments need to be less than the energy savings. The paper trail is easy for that if you're a nat gas customer, but as most of us know, in residential world, our customers are propane, heating oil, and sometimes wood. So how does it work when it's not obvious energy costs work?
We will find a way. Yeah, I can't tell you exactly what the paper trail is. I haven't seen any particular, but we'll, there needs to be an estimate of what the cost was and what the savings will be.
Hal, do you have experience with that?
I'd like somebody to write that down. We will find a way. Specifically, wood, because I frankly run into a lot of prospective geothermal converters. And they're converting because they're getting old like the rest of us, and they're heating with wood. And it's really hard to do paper trail on what it costs them to do the wood.
If it's not possible to find that, then the smart energy loan is the option, because that's not a requirement for a smart energy loan. But if there's a great desire to do the on-bill recovery type of repayment, we would do the best we could to.
And the smart energy, if I understand it, really is just the difference between it being paid for on bill or through an automatic payment out of your bank account, but otherwise it's essentially the same loan?
That's exactly correct. It is exactly the same loan, it's just the payment difference.
I just wanted to address that. In your building modeling software, I don't know which software you use, but you can do a before and after of the building. There's a design heating and cooling load feature in most of them, and that will produce what the BTU load is on the house, whether you're retrofitting it, improving it, or you're taking it as is. You can base usage on BTUs. Wood has a certain amount of BTUs. You just translate how much is being used.
Sure.
Good.
We got one more question back. They're good. It's good, and you should get that resolved. And we will. I do think there's a way to work it, just like you're saying. Yeah. Go ahead.
So one of the issues I've
Name, rank, and serial number.
John Piper, Kinetic Energy Solutions. Sorry. One of the issues I bump up against is you've got the 112 rule for the ODR, but you've also got a rule where you have to meet a 15-year payback in order to access over $13,000 on the smart energy loan. Can we get rid of that rule? Number one, because it's fine for a large.
Earlier, of course.
We will find a way.
Unfortunately, I have to find a way too, and I do find ways, but you wouldn't be happy with those ways. So
He gave an alias name, by the way. But
so one of the ways to go back to the gentleman's question there's an energy waiver form that you can fill out that you can estimate your usage, and it's accessible to NYSERDA. And you get you can also contact your oil company. But that rule makes it very difficult, especially for smaller residences, in order to meet that criteria. You know, it's great if you're blowing through $3,000 to $4,000 in oil a year, you hit it. But if you're frugal and if you're aware current sweaters, use less energy, it's very difficult.
Great, thanks.
Scott, did you want to respond to that?
Yeah, I was just saying, so, John, that's, a lot of what's in Green New York are things that we can control pretty easily. That's rule, and the 15-year payback above 13,000 are both interpretation we can do, but the harder things to change than some of the other things we talked about.
And that would be Scott Smith from NYSERDA. All right, we're going to wrap it up. I know. Between the panel and the crowd that I've now abused, I'm going to have to watch myself in the hallways. I just want to thank the panel. I thought that was terrific. So let's. I do want to go one quick. As a moderator, I try not to get too involved in sort of what our business is. But there's a couple of things that Tim. One of the things I gave a talk to a bunch of engineers about some different things, and I mentioned Tim's model at Diverso Energy, and I said that one of the funny things is that Tim, what really caught my eye when Tim first spoke at a conference was he talked about geothermal being value engineered into a project. So literally, he's saving them budget money, and they're getting rid of the boiler and cooling tower as a savings and putting geothermal in based on the way that he does it. And I just thought that was so funny because it's such a, usually anybody who's familiar with value engineering, it's kind of it's like an oxymoron. You take all the good stuff gets taken out, saved. And so it's just fascinating that we can find ways to value engineer something like geothermal in. So, all right, thanks so much to the next panel. So we're going to have the international standardization. Yep.
Good job, everybody.
We hope you enjoyed this presentation from the NY-GEO 2018 conference. We would like to thank our sponsors, exhibitors, speakers, and attendees for making this such a great event. For more information on this conference, including speaker bios, presentation slides, great photographs, and more session recordings, go to our website at nygeo.org. That's ny-geo.org. Thanks.